It's 5 o'clock in London. It's midday in New York by the time you're watching this. Midnight in Hong Kong, 4 a.m. in Sydney, 9 a.m. in San Francisco, 10:30 at night in Mumbai, India. Greetings, good morning, good afternoon, and good evening, depending on where you are in the world today. My name is Patrick L. Young. The IPO-VID Livestream Series 34, episode number 2, rationalizes itself into a beautiful number. This is episode number 200, ladies and gentlemen. Thank you, thank you, thank you. Here we are, back in a wonderful world for another exciting day. Over in Indonesia, there's been, pretty much a mass bloodbath. The majority of the C-suite and various other parties have resigned from the Indonesian Futures Exchange. At the same time, great news from India. It's happening finally, ladies and gentlemen. We've only been waiting for, a generation or so for this to take place. NSE IPO. It's going to be the biggest IPO of either this year or next year in the parish of exchanges. That's going to be taking place sooner rather than later, although, again, I think it probably will be next year by the time it happens. But finally, the Indian regulator, SEBI, they have said the National Stock Exchange of India can join the launchpad for what is promising to be a mega IPO of a very, very fascinating company indeed. Meanwhile, some great news from our friends at NASDAQ and also Japan's Osaka Exchange, part of the JPX group. They're adopting NASDAQ Eclipse trading and surveillance technology for their next generation derivatives platform. They've been on NASDAQ technology for quite a while. Now they're going to be going to the super fast, mega incredible stuff for, what else but a total eclipse of their trading system. How appropriate to have announced that over February's full moon. That highly competitive race, it leads elegantly, ladies and gentlemen, into our little NASDAQ-sponsored segment today. Pay attention. This is a really, really cool thing to be watching for because investor appetite for Asia is rising, but post-trade friction is holding markets back. In the new NASDAQ and Value Exchange study, 25% of participants plan to grow exposure. 46% face artificial trading limits. The biggest pain point, corporate actions. 60% report higher error rates and 39% of platforms are still legacy. The fix is clear. Harmonize rules, standardize workflows, modernize technology in order to unlock efficiencies in settlement and corporate actions. For exchange leaders ready to scale, download Creating Asia's Post-Trade Operating Model of Tomorrow. You can get that at bit.ly, bit.ly, and then you need a slash, and then it is APAC/post-trade. Asia Pacific, APAC/post-trade with 2 T's in the middle. That's on our screen as well, if you happen to be not watching this as a podcast version. Today, ladies and gentlemen, for our 200th episode, we've got a fantastic panel lined up. We are waiting for Mark Bettis. Unfortunately, he's not been able to join us so far this morning, hoping he's going to be with us before the time we get to the end of this show. This show is being recorded, incidentally, a couple of days in advance of being shown due to the simply frenzied excitement there is in the world out there and everybody's diaries proving difficult to mesh in real time. Joining Mark Bettis, who hopefully will be along in a little while, I'm delighted to welcome back multiple guests on this show, a series regular, Ann Berg, who is, of course, our commodities doyen, former member of the board at the Chicago Board of Trade, long-standing guru and producer of reports and other material for the likes of the UN Food and Agricultural Organization, and someone who has consulted, built markets and advised on all sorts of fascinating products right the way around the world. And when I mean right the way around the world, I really do mean it. And Anne has got the Turkish Airlines frequent flyer miles to show for it. Our third guest today, last but by no means least, another returning guest. It's a joy to see Daniel Davis, last seen in Chicago at that fabulous AFM Tech Day, which was hosted by Connemara EP3, and it's really fantastic to see you. Dan leads the sales and marketing efforts at Connemara Technologies, and before that you were in B2B with SaaS technology companies amongst other things, and you helped PIMCO grow their new office in Austin, Texas, with roles in the strategy and sales groups. Nowadays immersed in the wondrous parish of exchanges. It's a joy to welcome you all here today, ladies and gentlemen. Now look, here's what I want to talk about today. I think as an overall overarching thesis, we joined this in about 2019, 2020, people started talking about this. Could this be the roaring 20s, a decade of optimism, of hope, of incredible economic growth, amazing things happen? Then COVID. Suddenly the roaring 20s narrative dropped away. However, here's the thing. If you look at what happened in the 1920s, ultimately what was going on there was that we saw an incredible stock market crash. Not a lot of people remember this, but after 1907, 1920 was pretty much the biggie that had ever been seen before, of course, 1929 wiped that all away in the record books. However, if you think about it another way. The Great Gatsby, that was a book that celebrated its 100th anniversary last year. We had a special edition of Exchange Invest Weekend for that. My weekend, you can do for free at exchangeinvest.com. And indeed, when we looked at that, it's very interesting to compare notes on just how different the actual world of the Gatsby movies are to the real 1920s. So first of all, there's a lot of dancing to the Charleston in all of the movie versions, all three of them that have been made of The Great Gatsby. Actually, the Charleston didn't actually arrive until pretty much about a month before the book, The Great Gatsby, was actually published. So therefore, it clearly was not included. Moreover, all the movies always tell us about the stock market booming, but actually the stock market was only managing to make its way back to its all-time highs by the time the book was published in, March or April 1925. However, I think there's some quite fascinating synergies here, and that's what I thought would be fun to discuss, because if we look at the 1920s and impose those upon the 2020s, what we do have at the moment is an emerging stock market that is having an incredible run. At the same time, there's a huge cause for optimism and a huge number of new developments, new technologies. Don't forget, in the mid-1920s, one of the excitements was that people were starting to get terrestrial television in their living rooms through cable in the likes of New York and other major American cities. So the roaring 20s, what's happening in the world? It's been an incredible beginning to the year so far, actually, so much happening. And wow, where do we start? Do we start talking about commodity prices, or do we start talking about all of the geopolitical upheaval that's already going on?
Well, thank you for having me, Patrick. You've posed a really interesting and complex question here. I'm not sure how to answer that. I think what you're seeing is, yes, excitement in the equities, but such volatility that's I think is pretty unprecedented. And then you've got this excitement in the industrial metals and precious metals, obviously gold and silver, then copper, for example. And you've seen just in last week, and I hate to pin it down to a week, but just last week or so, that you've seen some rotation out of equities that underpin this AI movement and into the metals that are needed in order to perpetuate this kind of activity. So it's funny. I reread Fitzgerald's novel during last year, and I did find obviously similarities. Part of it could be maybe the decadence that's involved between the two centuries, but it was an interest. There was this hope, and this huge symbol of the green light was there. So I sort of see the same sort of symbolic hope that's extending into the 2020s here, as we're now in the mid-2020s.
Yeah, I mean, it's very interesting because at the same time, you hit on something I think is fascinating, which is you're talking about rotation. And it is intriguing that what I keep reading is lots of media telling me there's going to be a stock market crash imminently, whereas what I tend to see is we're definitely more in that sort of middle stage of a market, bull market, where, they're moving from one set of stocks to the other, and we get on to commodities in a moment. But it doesn't strike me that things are actually absurdly toppy overall, but there may be certain segments that have been incredibly on fire, like AI, for example, or whatever.
Well, one thing you have seen, obviously, is this huge development of the retail market. And this is, if you look at the CME, they've targeted their trading towards retail. And they've seen, as you reported in your last letter, that they've seen a huge uptick in this smaller segment as opposed to institutional activity. So that in itself is something that I haven't anticipated, but I mean, I should have, just because, yes, there's more connectivity. There's connectivity with information, so that the average investor now has information that was only available to the upper tiers of the investment, the institutional investors. So you're seeing that grow. But with that, you're also seeing, again, I think this huge volatility. You're seeing this shakeout Bitcoin and then gold and silver is just unbelievable to me.
Yeah, it's really interesting what we've been having there. And we'll come back to that in a second, I think, because Dan, I mean, you obviously must have a very interesting view here. I'm not asking you to give away trade secrets, but you're developing systems with Connemara EP3, you're delivering to clients, and you've got clients who are all pretty much at the cutting, if not the bleeding edge of new products, but they're in an entire gamut, the range from highly retail and one might say highly speculative all the way through to retail and institutional, lots of what we all love to see in derivatives markets, lots of risk transfer and related issues. It's a fascinating time for the development of these products, isn't it?
It's absolutely incredible. And thanks for having me on, Patrick. Excited to be on your bicentennial show here and really be able to celebrate that. And, news is moving so fast, markets are moving fast, and money is moving very fast. The velocity at which money is moving both through institutional retail and with new technologies is just absolutely incredible. And that frees up a lot of capital to be able to be reallocated quicker or collateral to be managed more effectively. And I think that's, also just perpetuating that velocity at this point. Firm believer in, efficient market theory. I know you read some of my background, but what maybe didn't come through is I've been brainwashed by Eugene Fama and Ken French and, their 5-factor model. And that information is reflected in the price of securities. And, we are evangelists of creating better price transparency and better price discovery through our technology. And we're really excited to see that proliferate in a number of ways, in a number of markets, whether it's prediction markets, energy markets, perpetual future markets. The tools for retail investors are just getting better. The access is just getting better. And we'd like to think that the technology supporting venues is also getting better.
It's really interesting, and I know we're going to have a chance to talk about this at greater depth one-on-one in a couple of weeks' time as well, because it's so interesting how fast things are moving. But you hit upon a really interesting comment. I mean, Fama and French, the whole efficient markets hypothesis, which was all the rage sort of through the 80s and then seemed to fall out of favor, it's come back. What is fascinating, as you say, is how the efficient markets hypothesis is being underpinned at the moment by a better quality of broader distribution in real time of data than we've ever seen before. And that strikes me as the one thing that is completely different from when the thesis was first postulated. Don't know if you have any thoughts on that, Dan.
I think the Fama French Army would still say that the data shows that, over long periods of time that those premiums do outperform, the value over growth or equities over bonds and profitability and companies. And I think we're seeing some of that sector rotation now. I'm not as close to maybe markets as I used to be when I was in that world, but I think that's still alive and well. If anything, I think prices are reflecting that information faster than they ever have. And everyone wants to think that they have some sort of edge, and to have a venue where you can put your money where your mouth is and get to a price that represents probabilities or represents what the market really thinks it is I think a good place for markets to be.
Yeah, it's a very interesting place to be. And certainly, I mean, Anne, it's so interesting how even commodity markets, which still trade, let's face it, a lot on their opacity as much as their transparency in many places. It's interesting, you look at like shipping technology and so on, and how that's able to monitor where all the ships are in the ocean at any one point in time, which has given us a whole new ability to see where literally the flows of commodities are, which was something that I can remember in my early career a few decades ago, that there would be allegedly oil firms who would turn off their trackers when they were outside of ports and nobody knew where the ship was. And then once they got the oil to go the right way, they drop it in.
Still happening. There's the quote unquote ghost oil fleet, of course, that everyone knows about. So that's still part of the system right now. But no, you're right. There's a lot more tools available, and as Dan says also, that are available just to the individual. But what I do see is the same pattern that I used to witness. You're talking maybe 40 years ago. That that still takes place in these commodity markets, which is that you've got the in the loop traders who see things first, obviously, and then that's followed by some more informed, but not as informed as the institutional traders. And then you finally get to retail. And I think you're seeing some of that is taking place right now in these commodity markets as we focus on, as I say, the industrial and the precious metals, what gets called the debasement trade, if you will. Because in part, there's been this story of this weak dollar, which I dispute in the sense that the dollar index at 96 or 97 is not particularly weak. We've seen it down during the George W. Bush presidency. I think we saw the dollar drop to 0.70. And not only that, the dollar index, if I may talk about this, is I think it's an antiquated index to begin with, because 57% of that index is against the euro. And then you drop down to the teens to the British pound and the Canadian dollar, and you've got a little bit of Swedish krone, which I don't think anybody has in their wallet. I have some in my desk because I've been to Stockholm. And then the Swiss franc at 3%. So it's not particularly indicative of the dollar flows and financial flows that are in existence right now.
No, I mean, it's a very good point, because, I mean, even that doesn't reflect remotely the makeup of central bank reserves, because the euro is what, barely about 20-something%, if I remember correctly, of central bank reserves these days.
Right, exactly. And I don't think that is there anybody who actually believes that some country is going to go back to the gold standard? I mean, it's Keynes said it's a straitjacket. It does not allow for any sort of credit and debt creation. And that's been the bane of these countries, is that they've completely overindulged in borrowing from the future and debasing their currencies. I mean, you look at, we talked about Turkey here, it's 10 years ago, 2005 rather. So 20 years ago, it was 1.6 to the dollar. It went down to par with the dollar, and now it's at 40. So, and same with the Indian rupee, that it basically gains in exports as it devalues its own currency.
Yeah, and I mean, there's two big problems you raised there as well. It's not only the still competitive devaluation of emerging markets, but it's the fact that really the mega economies that are coming on stream and have been growing hugely in recent years don't have convertible currencies, to wit China and India, just to name but two. And that therefore makes it incredibly difficult to actually have a dollar index, simply because there is not a proper functioning fungible market as we've been used to on cable or dollar euro or dollar yen for the course of the last 70 years.
You don't hear that much about a BRICS currency anymore. And
no.
What happened with India and Russia, as Russia was selling oil to India, that Russia had a stockpile of rupees in the Indian banks, and now because they cannot really repatriate them and get what they would consider decent value out of them, they're simply reinvesting them into Indian equities and other types of investments. So. It just goes to most of I think 90% of the trade in currencies is dollar linked. So that if you want to get out of Indian rupees and go into rubles or vice versa, you've got to trade, first of all, the rupee with the dollar and then the dollar with the ruble.
Pin it to masculine intuition, if you will. But I think, Anne, we've got a great panel session in the near future, because I'd love to get Kathleen Tyson along and we can discuss some of these knotty issues just purely of the Forex market. And her book was Multi-Currency Mercantilism, as you know. And I think that there's a really interesting conversation therein. I mean, Dan, lots of strands already opened in this show. We're not going to manage to close them all today, but at least there'll be future panels to enjoy. What about, the money question and the roaring 20s, etc.? I mean, the roaring 20s is really associated with the first mega rise of the US dollar in terms of becoming a global currency at the same time as Europe atrophied. Well, plus ça change there. Do you think technology has a role to play then in the future of money, or how things are going to go forward?
Yeah, how could it not? Right. I guess so. So much of our life is virtual. We're doing this show virtually. We trade virtually. Trading pits are long gone. But I'd maybe to regurgitate a comment I heard the other day. The dollar is still the best looking horse in the glue factory. If you're not using the dollar, what else would you be using? And I think a lot of those comments that you and Ann have said really underscores that. So. I don't know that I have too much of a view or too much of an opinion, but the technology is just moving faster than it ever has. So it has to play a role, and of course I'm a bit biased, but love to see, some of these maybe newer instruments, things like perpetual futures, be able to play a role in allowing people to keep maybe more persistent hedges or, proliferate their views in newer ways to, on traditional markets that have worked really well for things like crypto.
It's very interesting. I mean, then, that it's interesting you mentioned crypto, because not wishing to talk about the structure of crypto, one thing that keeps me kind of optimistic that we're in this roaring 20s thesis is the fact that, I've been saying this, good grief now, for more than a year, which is the actual price action of crypto, particularly Bitcoin, has not been that fantastic, as the underlying crypto economy has been growing underneath it. And it's quite interesting that we still seem to have this incredible number of people who are super bullish that Bitcoin's going to be worth $1 million or something. And yet it's really struggling to break 100,000, despite the fact that we clearly have much, much wider adoption and understanding of crypto going forward. But I think really the value we're seeing here, and I'm interested because you're in the front line, the value here has not really so far been in just pure crypto, but actually in the technology that's being distributed across new exchange models, etc.
Mm-hmm. Yeah, so much of maybe crypto is actually that's impacting financial markets, in my mind, would be more at the blockchain and more so what it can do for clearing and custody. With more real-time custody or real-time clearing, you can effectively pre-clear, pre-trade, and settle in real time. Back to my comments earlier, the velocity of money under that paradigm becomes just overwhelming, what you can do with risk at that point, or what you can do in terms of settling funds and, moving money more quickly is just incredible.
And it's a fascinating point, because you did make that earlier, and I wanted to come back to specifically one thing, because it's not just the speed of transaction trading and settlement strikes me. Actually, it's the speed of collateralization, because the ability to get collateral into the system obviously accelerates how much and how often people are able to trade, risk transfer, whatever it's going to be. But then at the same time, if we have an enormous amount of collateral that is not necessarily super liquid, I start to get worried that we could have a moment down the line where this is going to be tested, and we're going to find that maybe a little bit of cold hard cash from the glue factory might not have been such a bad thing in the first place. And now that's not to deprecate the underlying technology. We know that in cycles things go wrong, just that they did in 2008, because everything was as safe as houses, and what could possibly go wrong there. And I'm interested what you think, because obviously collateralization, commodities increasingly being used in collateralization, all sorts of things being put on blockchains and collateralized. It's a wonderful system, but it becomes presumably quite difficult to risk manage, because you do need to have a certain amount of really, truly super liquid stuff that you can liquidate very, very easily in a crisis.
Well, are you saying that there's just too much complexity or something? Because
no, I'm just saying what worries me is, if you end up with a huge amount of there's a huge amount of collateralization, which is stocks, bonds, possibly other assets, gold, even wheat.
Oh, you're saying if you use those as collateral, is that what you're talking about?
Yeah, you use all this as collateral. It's great while the system's all going well, but at the point in time when something goes wrong, I can sense that there could be an almighty issue in the system, because there's simply not enough cold hard cash to go around.
Well, that usually creates a collapse.
Yeah.
So, and what I have noticed also when you talk about collateral, that there's been collateral creep. So there's an increasing amount of collateral that can be used to back margins. So if that's what you're talking about, that's a problem for me, because you don't, I think there's been talk about using crypto as a collateral against, whatever. You don't know what it's worth from second to second. And you could have a run on that. And then, it no longer supports the positions that you want to hold. So I see that as something that adds to the volatility. In fact, if you go back to 2008 when we had the food crisis and you had these huge run-ups in the commodity prices, soybeans, wheat, and corn, and those prices exceeded what prices we're seeing today by twofold at least. I mean, you had soybeans at $17 and corn at $8. Corn today is at a little over $4. This is per bushel. So what you had during that time period, besides what the fundamental underlying reason why you had a bull market, which was just plain shortage. You had a shortage of grains after the European Union had kind of worked out all of its stocks problems. Saw during that time period when you had all of this money flowing into futures markets for grains only, was that they just completely lost their mooring from what the real prices were. So, you can't just say, well, it's all part of price discovery. Sometimes price discovery goes a little crazy because you've got, an influx of new money that was never there before. So, for example, wheat was trading at $12 a bushel on the Board of Trade contract, but the farmer was only getting $6. So the farmer would go to the bank and say, well, I've got a margin call because I hedged my wheat at $6. It's now $12. I need some money. And the bank said, forget it, because the cash market is not following. And there were a lot of bankruptcies during that time period.
Yeah, so, and it's really... Go ahead.
Well, just to bring that forward, I think you're seeing the types of volatility that you are right now in the maybe some of the metals markets and so on. What is the real value of gold? What is the real value of silver? These are kind of hard to determine when you've got all of this screech going on into the futures prices.
Yeah, it's really tough. And also the other thing I think, moving on from the collateralization point, one thing that strikes me, and you're talking about 2008, all the people who are talking about this is the mega collapse and so on, it strikes me that we have an inverted commas healthy market out there because lots of things are rotating. Whereas 2008, for example, was for me the most unprecedented market I've ever seen because everything was bullish and going up simultaneously. I mean, everything, stocks, bonds, every kind of commodity simultaneously was going up.
Well, it was called the hedge against inflation. It was part of it. So, that you would want to get your hands on everything. That included, the raw materials. And, you're very right on that. And all of these tracking funds that developed during that time, they tracked all commodities. And then there was a kind of a divergence among the commodities so that when they came back to ground again, to say, well, maybe corn and crude oil and copper shouldn't be moving all at the same time. They've got their own fundamentals. And then you've got right now a differentiation among the various commodity groups and actual commodities where, you've got cocoa that has run out of supplies. You've got too much wheat, way too much wheat because it's either being produced in Russia or the Ukraine, or the Polish farmers they're still angry over the amount of commodities and Ukrainian agricultural products that come into the Polish sovereign nation. So that's been just a real bottom clinging commodity along with corn and soybeans.
Yeah, quite fascinating altogether. I mean, Dan, it's interesting in your world because you've been developing some quite fascinating pricing structures recently right across the board. What sort of trends are you seeing? What do you think is particularly interesting about the way we're working in the current market space?
I can't comment as much on 2008. I think I was in 7th grade when that happened. So I'd maybe have other things that I'd think of maybe more about geometry or algebra at that time. But, in the current market space, it's I think Ann would probably even say that, and yourself would say that we're seeing, much of what we might have seen during that time or even before that time where there were instruments that were being revitalized or, a different, type of lipstick put on it or, sort of, restructured. And, we're seeing that with things like perpetual futures now. I mean, even prediction markets, your history there. And with InTrade, I'm still waiting for the movie to come out. But a lot of these, newer instruments we're seeing maybe aren't new as far as the thinking behind it, as much as just the ability for it to really resonate with people that want to participate in their personal economy, or the institutional players that really haven't had access to these markets. You think about power nowadays and just how much power AI data centers using, or battery operators, and how do they hedge, their exposure to that sort of asset class. We have a great customer, Electronics, that's allowing, those sorts of participants to really enter the market and provides them a hedge that they historically haven't had such simple access to. And I think some of the simplicity of these instruments, some of the just the lens to that adoption by retail, of course, with all the technology that has also allowed them to have better connectivity and access to those types of instruments. But I think even some of the newer instruments that we're seeing are maybe more so sequels, or of a movie we've seen before.
Yeah, it's really, really interesting, isn't it? I mean, you're looking at what's going on. I think some of the stuff you're doing is intriguing, because actually, like Electronics and other markets, they're bringing also hedging power to retail investors increasingly. And that's something that a lot of talk is all about, the speculative power of retail, which clearly is taking place at the CME day in, day out increasingly, for instance, not just Robinhood and all these other platforms. But it's fascinating when people are now starting to deliver the tools of relative financial sophistication that can allow people to manage their finances in a much more interesting and better fashion.
So much of my generation is, prudent in how they invest. Low-cost index funds have been drilled into our brains, since a young age. And, I still invest that way. And I think, for the person that has exposure to certain asset classes that want to get a hedge, it's easier to do that now than it ever has been before. If for people that want to speculate, it's easier to do that now than it ever has been before. But, I still think, a lot of this generation that's, investing or speculating or hedging, subscribes to low-cost index funds and sort of passive, or a mix of passive and active. So, I think that's probably the larger undercurrent is passive investing, but just see new products out there for people to invest, that kind of on the margins of, the risk that they have, or the excitement that they want to get out of speculating, I think is certainly there.
It's interesting, and I totally agree with what you're saying, but also it's quite fun to speculate on the idea that right now everybody, or lots of people, are just going, it's really easy. All you do is buy some ETFs, track the index, and everything's going to be good because it's always been good like that. Well, they invented bread. We were talking about this before the show actually was recorded. They invented bread, in Anatolia about 12,000 years ago. And in all that time, there's only actually been roughly 50 years of 12,000 where it made total sense to stick all your money in an index tracker and not actually try to be a vaguely active manager, which is something that could carry on for the next 50 years. It could carry on for the next 500. Who knows? Because as Keynes has always said, in the long run, ultimately we're all dead. But there's an intriguing pointer in there about something about how we started to take markets for granted in the way that they're going to kind of operate, which I suppose may go against the idea that we're midway through the Roaring '20s. That might be the point at which we're going to see some sort of a crash. Now, let's give the panel a little bit of a break here. Sorry, go ahead, Anne. Go on.
No, that's the debasement trade. Is it? Let's put our money into some of these real things. And I think it's a little bit of a precautionary tale just to look at Bitcoin, which was supposed to be the future. And now it just seemingly doesn't have a friend, as you've pointed out, Patrick, so many times. And things can reverse in ways that, nobody told me this would ever happen.
Yeah.
So, we're seeing that. But there's a point that Dan made about hedging and all of these kind of exotic products, I think I would call them, and that were not hedgeable before. And what was done previously to hedge was simply increase margins, so that if you had, some sort of spread between retail and institutional prices, you would just increase those because you had to build in a bigger margin. And it ultimately then went back to the retail customer who always took the brunt of it. So I think these markets, as Dan, as you have developed, and are really helpful ultimately to the retail customer.
Dan?
Yeah, sure. I mean, I'd love to agree with that, and thank you, Ann. We're, if anything, we're more, yeah, well, I think we are most passionate about, kind of to that point, on being able to open access to instruments people haven't historically had access to, and to provide venues, the technology to venues to allow them to do that. So, in that sense, I think, we're playing a small part in, moving that forward and like I said, creating more, just price discovery as part of that. But, there's still, I think, a long ways to go in terms of either that access or the discovery of prices, or, I saw an article this morning just about vibe coding, and I think retail is just going to become, more sophisticated in how they're vibe coding algorithms, or, becoming to look more like, sophisticated institutional investors. And, with that comes, more flows, and that'll, be interesting to see how some of that shakes out.
And that's actually fascinating, because, I can, looking at how over the course of the last 20 years, lots of things have been laughed at. Cloud computing, never going to happen. Everything will stay on-prem. Gamification of markets, not going to happen ever. Everything will... We know that went wrong. And then, as you say, vibe coding, all of that sort of no-code, low-code vibe coding movement is completely changing markets, because while it does not take away or detract from the need to have Connemara EP3 at scale to operate the actual marketplace, the truth is, if you're interacting on one node, there's a heck of a lot you can do right now with a huge amount of data in order to make yourself a more competitive trader. And that's great for everybody in the ecosystem.
I couldn't agree more.
On that point of heated agreement, we're going to go, ladies and gentlemen, to giving the panel a brief rest at this juncture. We've got Dan Davis, Head of Sales and Marketing for Connemara EP3. We've also got our commodities doyen, Ann Berg, alumna of the UNFAO, Chicago Board of Trade, and many, many other great commodity houses in between. And let's stick to commodities for a second, because let's talk about oil. Our Big World video for the week is talking about the oil map redrawn. Here I am today recording this from Grand Turk, and I can tell you, we had a few fast jets came overhead in the middle of the night a few weeks ago when President Maduro was being renditioned from the Socialist Bolivarian Republic of Venezuela to the Socialist Bolivarian Republic of Mamdani and the Southern District of New York. What does that mean, though, in terms of what's happening at the moment with the oil map redrawn? Here's a 1-minute video. Meanwhile, in Big World, I'll get into the specifics of the impact of Venezuela's regime change in due course. But first, it's worth considering how the Trump regime just removed one of the 3 top oil exporters who are not naturally sympathetic allies of the USA. The remaining duo are Russia and Iran. For more in Big World, like or follow. And actually, I'm going to slightly contradict myself, because that was made just soon after the Maduro rendition. What we have seen there is actually genius. It's not regime change in the old-fashioned American model. Effectively, the Chavistas are still in charge. But for those who are not in the know, well, the Saturday after Mr. Maduro disappeared off to the Southern District of New York, a large Hercules plane arrived at Caracas Airport full of electronic equipment and a number of Marines, and it promptly installed what I suspect was not just a new central heating system for the previously abandoned American embassy, but also rather a lot of surveillance and big data equipment, which means that the Bolivarian Republic may still be in existence, but it seems to me that they're somewhat more pro-America than they once were. Brings us neatly today to the book of the week this week, back to Finance Book of the Week, Other People's Money, The Real Business of Finance, by a great IPO-VID alumni. Watch that show when you get a chance, ladies and gentlemen. John Kay, he gave us a fascinating insight discussing how the finance sector needs to be reminded of its primary purpose. Oh, it sounds a little bit like Shades of Today, underlying or underpinning our Roaring Twenties thesis. That the money business is here to manage other people's money for the benefits of businesses and households. Main Street versus Wall Street, writ large, is an aberration when some of the finest mathematicals and scientific minds are tasked with devising algorithms for the sole purpose of exploiting the weakness of other algorithms for computerized trading and securities. to travel further down that road leads to ruin. You may not agree with Sir John Kay's thesis, but I got to tell you, it's a compelling book to listen to or to read, depending on what media you prefer your books in these days. And don't forget, if you want all the news on the bourse business, ladies and gentlemen, join us at exchangeinvest.com. Exchange Invest Weekend's absolutely free. You can sign up for it at exchangeinvest.com. And also at the same time, take your 7-day trial. It's only $499 once that trial ends to be at the water cooler of the bourse business, the exchange of information, and you can learn everything that's going on about the parish of market structure in these supertastically exciting times, as evidenced today with our discussion between Ann Berg, our commodities doyen, and the head of sales and marketing for the fabulous vendor to exchanges, bourses, and cutting-edge markets the world over, Connemara EP3, Dan Davis. So, guys, I mean, to go back to where we've been recently, actually, the upheaval in oil is quite interesting. You mentioned Electron X, obviously, earlier, Dan. I mean, that's a major market, but quite fascinates me, Anne, that we've had an amazing upheaval in Venezuela. I don't want to speculate on what's going to happen in Iran, but it does seem to me that the Americans have parked a lot of hardware just around the borders of Iran, and it looks a bit like the military scenario of Meet the Fockers with Robert De Niro going like this towards the mullahs, the Islamic regime. But certainly, I mean, you mentioned earlier on the fact of people talk about, oh my God, the dollar's so weak, and yet actually it's really nothing compared to me. It's a mere tiff compared to where we've been in the past history of the dollar, let alone Plaza Accord time, Louvre Accord time, or whatever. Oil. I mean, you had this amazing one-night operation in Venezuela, completely changed what is de facto the mega swing state producer if it actually got its act together with more resources than anybody else. Now we've got Iran coming up, and yet the oil market seems to be remarkably subdued. I mean, we're not even anywhere near three-figure oil at the moment.
Well, yeah. I guess you would say that, well, for one thing, the U.S. has completely changed the oil supply, and because of all of the fracking that's gone on and so on, oil is the number one export. Oil and petrochemicals are the number one export from the United States. And it wasn't, 5 years ago that the export ban was lifted? It was probably a little bit longer than that. But in other words, the U.S. wasn't allowed to export any of its oil because it was so critical to maintaining, our standard of living. So there's don't discount that revolution, which made the U.S. Top producer, basically. So that's part of what goes into the price right now. That it's not soaring and so on. We're not captive. I mean, I think this latest operation in Venezuela shows that the U.S. is just simply not captive to the quote unquote former OPEC and cartel, the oil cartel.
It's amazing, isn't it? I mean, we can remember the days when OPEC was the thing in the oil market, and nowadays it seems to be, well, it as a group, it seems to have become more like a swing state or a group of swing states rather than the overall thing that defined the price as it did during the 1970s oil crisis.
Well, and also I think Russia probably is trying to maximize its oil exports, production, and so on as a tool for war funding. So, everyone's competing with that.
Yeah, it's a big change altogether. And obviously, Dan, I mean, it's fascinating for you because, I mean, you mentioned Electron X and the way that those markets are changing and the whole electricity, power, oil, gas nexus has moved from, back when you were in seventh grade, which is good grief, only about a year before I started trading options, I now realize. And they were at, seventh grade rather than the actual year. I was already trading options by the time you were in seventh grade. But by the time you were in seventh grade, nobody was thinking about electric cars. Nobody was thinking about the way that the power source battle was going to change. And indeed, sitting here in sunny climes in the Caribbean, the way that solar is revolutionizing the whole delivery of everything.
It's incredible. And I think batteries are only going to get more efficient, right? And I think that allows people to maybe live in exotic locales, which, I think is pretty exciting. Down here in Texas, I mean, we're very very flush with oil. To Ann's point, the shale revolution has just totally changed the way that people produce oil, the amount of oil that's here. And I've never seen oil in Texas above $3 or rarely above $3 and never above $4 a gallon. And might have to do some conversions for you there, but the price of other things has just absolutely skyrocketed. The cost of living for Americans, and there should be more venues for people to either hedge those or speculate those markets. So you think about either healthcare, or you think about things like compute, which is a very opaque market. We're seeing more venues, pop up that are really trying to attack maybe more of those high cost of living type asset classes.
Yeah, and actually, I mean, you mentioned it's really good, and also, in fact, where I'm sitting at the moment, we're due to a regulatory monopoly. We are not allowed to access Elon Musk's Starlinks that are essentially whizzing by, being ignored when they're over this part of the hemisphere, sucking up the bandwidth from Jamaica, Haiti, Dominican Republic, all the way around, and so on, and still not permissible to be used here, which is kind of crazy, because that's another revolution that's really changing the price of bandwidth fundamentally, which is another instrument which people have tried with, but have not really broken through here. So I can sense the ready optimism within Connemara EP3, as you've such a history of developing new markets, all the way from environmental products, which was in your DNA from the start with Doc Sander. There is no shortage of new markets or products that is going to be developed.
Not at all. I think Sandor, last time we saw him, said that space debris was next. I'm still trying to find, the visionary behind that market, and would love to talk to them about developing that. But things like compute, we are seeing, and maybe to your point on Starlink, how exciting was it when at the Association of Futures Market annual meeting last year in Nairobi to see and talk to people on the ground there that had just been turned on to what consider the modern day internet with Starlink, the Nairobi Securities Exchange has a massive goal to bring on more retail investors, and you see a very vibrant betting market already with what Starlink's done to people of Kenya and Nairobi, and to be able to bring those investors or bring their economy along and their citizens along with their economy, I think is really exciting. It was just incredible to talk to my taxi driver, and he's surfing the internet for really the first time in his life. Before that it was largely broadband, or he'd have to go to an internet cafe. So things like that I think are really, really exciting, and you can't even really speculate how that will impact some of those emerging markets.
Yeah, and you look at the way, actually in Nairobi, where, as you say, we both were last year, and thank you once again for that beautiful day out at the safari. It was absolutely epic. I love the concept of Nairobi, Kenya, somewhere where you've got a great metropolis that has a safari park in the middle. It certainly makes even the gorgeousness of the Phoenix Park in Dublin look somewhat amateurish, because their giraffes are just rubbish in the middle of the park. I know there's a zoo in there for anybody who's asking, but it's not quite the same as seeing herds of antelope just wandering by your Jeep, right? And but it's very interesting, because Nairobi, they kicked in the Nairobi Stock Exchange this last week, and they're talking about bringing online M-Pesa users and all these other people that are using electronic money, and that's absolutely vital, because it's a really, really interesting facet. And this is intriguing as a way to increase the distribution to people who are basically banking on a cell phone, and they can now use cell phone signal and Starlink signal in order to manage to improve their access to the rest of the world, and therefore increase the way that they can trade and hedge and so on. That's just got to be super exciting. So look, let's start to round up the show here. Traditionally we would ask, where does the capital market revolution go next? But I know you've answered that several times, but you're welcome to therefore answer the question in either which way you prefer. Either where does the capital market revolution go next as a result of the flavor of this show, or indeed opine, are we actually in the roaring 20s once again, or is it something entirely different? Let's have ladies first. Anne, either question, how do you feel?
You always try to get me into the most difficult positions here. I'm not sure, really. The roaring 20s, I see a lot of, if you want to talk about market froths and maybe some decadence, I guess I have to throw in, then yes, I can sort of see that for today's market. I think there's an awful lot of, I hate to call them uninformed, but you've either got informed traders or you have uninformed traders, and the uninformed tend to follow, it's the fear of missing out, the FOMO trade, more than the other ones. They'll be quickly disillusioned from that, just because they won't be able to trade anymore if they lose enough money on certain things. And this is a market where I think unless you're really sophisticated, you're bound to lose money. I mean, if I'd been trading, I know I would have lost money, and I made a living trading for about 15 years. So I don't think that answers your question, Patrick, but I think that's about as far as I want to go in terms of that. But I do want to say that a lot of Dan's remarks about improving mankind and improving, the health of people and their participation in the financial realm is really spot on. That markets can really help to integrate people into a society, or improve their mental health, their physical health, and so on, and also their financial health. So I really applaud Dan and his thinking on this, and that's kind of my comment.
Fantastic. And most interesting and erudite comment it has been. And thank you so much for joining this panel again this week. And Dan, let's leave the last word for you. Roaring 20s, Capital Market Revolution, where we go next, whichever you wish to opine on.
Well, as a efficient market student, I could not make a much of a forecast other than maybe around those premiums. But you can't predict the future. We know that, but you can certainly bet on the future now, which is awfully exciting for our company. And like I mentioned earlier, and Ann says, I mean, to see emerging markets becoming more developed and people getting more access, I mean, it tickles us to be a part of that and to sort of be in the middle of it. Now there has to be a reckoning. To Ann's point, we've got a lot of overextended retail traders, and maybe dumb money chasing smart money. And you also have a lot of venues popping up. You saw the CFTC had five new DCM applicants in the month of January. Everyone wants their own exchange. Even Robinhood now has bought their own exchange. And you've seen just a tremendous amount of money move into these acquisitions and into investing in new platforms. And, it's going to be interesting just to see how all of it plays out and who really separates as a leader versus maybe who will be left behind as a laggard in the parish.
And on that magnificent, emollient and fascinating note, which will stimulate us for some time to come, I want to say a huge thank you. We've been discussing the Roaring 20s, and wow, what a huge realm we have managed to get through in the course of less than 1 hour, ladies and gentlemen. Thank you for watching this recording, which has involved our commodities doyen, Ann Berg, a woman of renown in the parish of exchanges, particularly on the commodity side, the magnificent Daniel Davis. Dan, it's been a joy to see you once again, talking about all sorts of aspects of the marketplace in and around your intriguing position shaping the future through Connemara EP3 and your technology company. And I'm looking forward to welcoming you back next week, ladies and gentlemen. We've got another very, very exciting show coming then, which is going to involve our guest, Gary Norton, and he's going to be coming to us from Australia. It's going to be another recorded show. He's in Perth in Western Australia, and an established life floor veteran now who is very much involved in the world of digital market electronic trading. We're going to be discussing from sim to reality, profiting from floor skills with Gary. Only remains for me to say thank you very much for watching this, our 200th episode, ladies and gentlemen. What an incredible achievement that has been. I think that deserves another round of intense applause. Particularly our production team today. Thank you very much, AJ, Desiree, and Jamil, for making this such a smooth show, and especially our extra special wonderful guests returning this time, Dan Davis from Connemara EP3 and the redoubtable Ann Berg. We look forward to catching up with you again this time next week. Same place, same sources as usual. I wish you all a great week in life and markets. And don't forget, if you're missing us in the meantime, drop by exchangeinvest.com for the water cooler of the bourse business. Have a great week in life and markets.